I think we're definitely seeing the glass half empty right here. You know, we had this big run up. We got to a level where everything seemed to be running on, easy street. And suddenly we have the big trade war, tariff problems again. They reemerge and the markets come down 6% from that point. What's left? 4% more, maybe it can go down 10%. I think that is not, it's not unreasonable. Is it unhinged? Do we think of the president as being a CEO and we have to think through every implication about what he might be doing or saying? I don't think that we really have to go that far, but certainly there's some downside. But if we go down 10% from where we were in early May, we're selling at under 15 times earnings next year. That could be a very reasonable and attractive price to buy stocks again.
Right, if you know what earnings will be next year.
We never know. No, we don't know, but we're giving no credit for earnings this year and some improvement for next year.
Right. Scott, you asked, okay, is this the same as December? What's different? Here's what's different. This is not Powell, but it is the market trying to get Powell and the Fed to react. That's why the inverted yield curve, now it's 4 days, the fourth day of this inversion, getting worse. And I'm not talking about the 30, of course. I'm talking tens and twos, which is what we look at for that. But the market is screaming right now to them through the bond market, not through the stock market, through the bond market, that this is what they want to see. They want to see rate cuts. And if they don't, then this inversion is going to stick around for longer. The longer it sticks around, the more people get afraid that we're going to go towards that recession. So I would say we're going to get that call that Pete made very prudently just a couple weeks ago, a 2% yield on the 10. If they don't start cutting fast, that will be because of a recession, Scott.
Yeah. I mean, it was a growth scare in December, maybe exacerbated by a Fed which appeared to be sort of tone deaf to what people were screaming around the world in certain pockets about the trajectory of the economy.
And instead of a lead foot on the accelerator, they were worried about the Fed having a lead foot on the brake, and that they were braking too hard. And many folks thought that they didn't need the December rate hike. When he came out and then did his pivot, that helped. But now, with the market telling them yet again, we really need a rate cut, there's virtually no way you could read this anyway but the bond market screaming that you're not listening to us.